Which chapters are included in midterm? It's excellent question. Okay, I'll tell you.
No, I don't know it, but I just want to confirm.
Yeah, I'm going to let you know. Just right now. Okay, so the chapters that are going to be included in the midterm. I'm going to actually write it on the board for you. From chapter 1 to 7 and 9. Okay? So it's going to be 8 chapters, but no 8 in here because we haven't talked about it yet. But 9 I'm going to cover it today, and we already covered chapter 1 to 7 previously. Okay? Anything else? Okay.
Well, Professor, did you say there's going to be 40 questions on the midterm?
Correct.
Okay.
But the good news was that what? Most of those are what? In your quizzes that you already answered. So basically you're going to say the same things. Maybe a couple of them here and there, number could be different, but basically it's the same. Alrighty. Folks, today we're going to talk about stocks. Very exciting topic, isn't it? Yeah, actually it is, because one way or another, somehow and somewhere and to some degree, you're all going to be involved in having or being part of the stock investment that we call in financial market. And typically, that's the stocks. Now, why? Because first of all, whether you even choose to buy or sell stocks, regardless of that, if you're part of any organization, any company, any firm in the United States, you're going to have 90% of the time, this is true, you're going to have 401k part of your incentive, part of your reward system in the company. Now, 401k basically is one way of investment for your retirement. Therefore, for your 401k is going to contain a bunch of stocks, which mostly, of course, majority of them, thank you, are the stocks of your own company. But also they're going to be investing on your behalf on different stocks in order to what? Diversify your portfolio. We're going to talk about some of this stuff. Yes, please. So when they do that, of course, they're going to manage it for you, okay? But don't you think that it's a good idea also you know how they manage it? Maybe you look at it and understand why they want to buy this stock, why they want to sell this stock, and what is the role of each stock in your portfolio. But the most important part of it is that now you're retired. They're not managing it for you. You got them. It's in your lap. What are you going to do with it? Follow? Yeah, you could just take it as a bundle and put it in somebody's lap and say, hey, manage it for me. Even then, do you know how they manage it for you? Do they even care to manage it for you? Do they make mistakes? Do they, again, it's not about the mistakes, it's about caring. Because you may put it in the hands of people and say, okay, well, that's fine, as long as I get my fee, you know, okay, I have it here. But do they manage it properly for you? Maybe not. Actually, if your amount of the money that you're putting in the hands of, let's say, any brokerage firm or any investment firm, let's say Fidelity, Schwab, and all these people, if you don't have substantial amount of the money, to be honest with you, they are not going to care about you. You're going to be in mercy of market, as good as managing it yourself. However, they give you advice. They tell you what to do. But my point of bringing all these to your attention is to tell you that you better gain some knowledge about stocks. Another benefit of it is that how to prevent big losses. What I mean by that is that if you may have good amount of money in your future, in your business, in your company, and then somebody says, you know what, hey, why don't you invest in the stock market? And that somebody, of course, is like your cousin, your friend. Okay, why I need to start invest on it? Oh, it's going to go to IPO. It's a high-tech company. It's going to gain you a lot of profit. And you follow those people. Guess what, folks? Why I'm saying that, what I dare to say on your behalf what you're going to do, because this is the majority of our nation. Majority of people in the market, they make a decision just like that. Oh, my cousin told me this is a good company, so I'm going to buy these stock, and then all of us can find out that your cousin was wrong. Now, so what do we need to do? What you need to do is you get educated. That's all you need to do. And education, of course, we're going to do very basics of it here in this class. You're going to get some ideas how to evaluate, how to value stocks, come up with the true value of the stocks, and all these. I'm going to use some method as to how you're going to determine intrinsic value of stocks. But this is only a fundamental. This is the very basics of it. There's a lot of other stuff out there that you need to learn. But the moment you learn what we're going to be talking about today, perhaps it's going to be a good platform for you, at least not to make mistakes. Okay? So let's talk about stocks. The stocks are financial instruments. They are called financial assets. What's the difference? Okay, remember, as I said in the past, I'm going to talk about, when I talk about certain things, I'm going to use certain financial words, particular vocabulary of the finance. Some of them are technical terms. I'm going to explain those as I'm speaking to you. However, subconsciously, I may not catch myself that I'm saying that. In that case, what are you going to do? Hold on, then. What was that? Then I'll explain it to you. Okay? Please do that, because I'm not always aware when I use certain terms, and I'm assuming, or I'm not even thinking, that you may not know the meaning of it. So, therefore, also I'm going to ask you about a question. The questions are about the thing that we talked about, and I want to make sure all the things that we talked about, some of them are so important that I want you to learn. Because if you walk out of here and you do not know a few things that are very, very fundamental in the world of finance, shame on me. Okay? So, therefore, when we talk about stocks and investment, we'll talk about the financial assets, like I said. Now the question is, what is financial asset? I use the term here, financial asset. What is it?
A financial instrument that you would expect to give you a positive cash flow.
Okay, that's one way of saying it. Think about it. Okay, let's just go from, take it from this particular perspective. When we say asset, what are we talking about?
Claim on asset? Claim of ownership?
Well, not claim, let's say claim, that would be equity. Okay, claim on the asset would be equity. But asset itself, anything that has value, basically. Of course, we're talking about material, not human psychology. So we're talking about the material that has value. Most of the asset that we refer to is what? Either called physical assets, or operational assets, or terms are used to describe everything that we own that has value. Your laptop is a physical asset, okay? Your cell phone, everything that you own, your automobile is an asset. Your home is an asset. But those are physical assets. In many cases, they're also referred to as operational assets. Now, today we're talking about financial assets. We're not talking about physical assets. So what is financial assets? The best way of saying this, if you securitize your physical asset, it becomes what? Financial asset. Oh, Dan, what did you say? Securitize? What the hell is securitize? Anybody? What is securitization? Okay. Securitization is converting your real asset or your physical asset to financial asset. How can we do that? Yes, you can. Okay, how we can do that? All right. You as an individual, you can't. But you as a company, you could. Okay, as a company, if I am issuing bond is what? Financial asset. What is bond? We talked about it, right? What is bond? It's piece of paper, nothing but. But just because this is backed by a real asset or physical asset, and you converting those assets and making it in form of what? Paper, becomes financial asset. Can you, is that the definite condition that it has to have physical asset or real asset to back it up? Yes, but also you could have financial assets that are not backed by anything. Like what?
Bitcoin.
Bitcoin is a good example.
Junk bond.
Junk bond is a good example. Now, why in the world people are willing to pay money for these? Because they operate, the value of it is determined by supply and demand. That's another phenomenon in our economy, in our market, in the world. I don't know, let me just give you a silly example. Look at this. What's the value of it? Maybe $10, right? If for whatever reason people are in demand for it and want to buy this, it's going to increase in value. And if the rumors goes out there in the speculative market that this is a magical product, man, it's one of a kind, guess what? The demand is going to go up for it, therefore the value of it is going to go up there. It may be selling now to $100, but is it really value of it's $100? No. Just because people want it, they increase in the value. Simple as that. That is true about not only about any product, but everything in life. Why do you think the exchange rate of certain currencies are appreciating and some other depreciating? It's not that in overnight one country got bankrupt and the other country is booming. No, that's not the case. They do because of supply and demand. Meaning that some countries, they say, okay, we're going to be having the reserve of this particular country's currency in order to enter the international market. So what is the most stable currency in the market? Oh, dollar. Let's buy dollar. Well, then when the demand for dollar increases and people want to buy dollar, the value of dollar increases in relation to other currencies. Does that mean the United States of America are becoming so better than everybody is in that matter of time? No. It has nothing to do with that. Well, it has to do, but it's in long term. In short term, countries wouldn't change within a couple of weeks. But in a couple of weeks, you see major fluctuation of the value of exchange rate between different currencies. Why? Only supply and demand. Now why demand is increasing? Because of many things. Most of them are what? Speculation. That's what I'm trying to tell you guys. Asymmetric information. Perceptions, if you will. So here, we're talking about the difference between financial asset and real asset or fiscal asset. Now, many companies would like to securitize their fiscal asset or their real asset. Why? Because they want to make money. I have a company, estimation of this company's value is $100 million. I want to raise capital, I want to raise money. Well, I have avenues to do that. But one of the simplest one is that to tell people, hey, you know what? I'm going to issue a piece of paper and I'm going to sell it to you. Or what are those called? Bonds and stocks. It's a piece of paper. So I'm going to issue the stocks. You're going to buy it, you're going to give me your money. And with your money, I'm going to make money. I'm going to be issuing bonds. You're going to lend your money to me if I hold on to this piece of paper, that's called bond, and I'm going to make money with the money that I got from you. That's what the companies do. Therefore, when you securitize the real asset and issue papers on behalf of it, those are all called financial assets. And remember what I said, I think I mentioned this, even your money in your pocket is what? Financial asset, isn't it? And I think I mentioned in this class that if you read the bill, dollar bill, what does it say on top of it? Have you read it, money ever in your lives? You never read money? You own and hold money all these years. You never read it, what is printed on it?
This note is usable for debts, public and private or something?
Grab your money. Take a look at it.
It's backed by the full faith and something.
Oh, of the U.S. government. Yeah, that was my question that was coming. So it's not backed by a physical asset?
Money is not?
No.
Why?
Right? It's on faith.
What?
Not on the gold standard, so it's on...
Yeah, it is, but it is, because real asset is the federal government and Federal Reserve. The wealth of the Federal Reserve and federal government is behind this.
Yeah, but it's just more of those.
No, it's not. Because government has financial assets. And Federal Reserve also has financial assets. What is that? Fort Knox. The gold is still there, my friend.
Yeah.
But they are not using it as a standard. It's just but it's wealth of the Federal Reserve. And that's what we call it reserve, Federal Reserve. What reserve? Oh, reserve of gold. That's what it is. Yeah, I'm sorry, Stephen?
No, I was going to say, to his point, isn't it true that in line with what the gold standard was originated to represent, we don't have an equal share of gold in Fort Knox that we used to have?
Absolutely. Absolutely, we don't. Actually, in the financial crisis alone, he printed close to $3 trillion without putting anything behind it. So, what does it do? It adjusts itself. How? Well, the value of it goes down. You see, when you print a lot of money that has no backing, the value of money was going to go down. And exactly what happened to our dollar for a number of years, the value of it went down. But it comes back and adjusts itself in the long run, because our productivity increases and our money adjusts to market and so many other factors. But the reason I told you guys to read your money, it says few things, of course. But the most important thing that is written on this, it says what? Can anybody look at it and tell me what it is?
Yeah, this note is legal tender for all debts, public.
But go on the top.
Oh, Federal Reserve note?
This is Federal Reserve note. Piece of paper that Federal Reserve gave to you. Note, you know what note is? IOU note. What do they owe us? Well, by historical standards, they owe us gold. meaning that you must have gold in order to have money. And we're talking about the history, not now. Because gold was the standard of the value for all the countries. So why in the world Federal Reserve gives you this piece of paper that has value? Because you gave them your gold. Again, historically, that's our establishment of our monetary system in the world. I'm going to talk about this later also when I prepare you for your final project. But for now, what I'm saying is that your piece of the paper that you have in your pocket is financial asset that is backed by certain real assets. Now, again, does it have to be real asset backing it up? Not necessarily all the time. Many financial assets don't have any real asset backing it up. Now, why we issue it? Because they are instruments that they have high risk, but also high return. So is it something that I choose to have? Yeah, if you want to balance your portfolio and make it a little bit more aggressive, it's a good idea. You follow what I'm getting at? Those are for those sake only. You never want to go and have a $1 million and then put them all in junk bond, because you're committing a suicide here. But you could buy junk bond and balance your portfolio, make it mitigate the risk. We're going to talk about that also, I think, next week or the following week, how you do that. Okay, so the stock is a financial asset. Now, stocks do have certain characteristics. In our understanding about the stock is paramount for our decisions. We have to understand some facts on the life that majority of the people in all the countries, regardless, here in our own country, they are not aware of it. What is it? Is that you go ask, I bet you my bottom dollar, you go ask majority of the people that buy and sell stocks. I'm talking about public, not stock analysts, not people that are in stock market. We're talking about the ordinary people like you and I, when they buy and sell stocks. Go out and interview these people. Majority of them are going to be telling you that, yeah, I'm going to buy this stock because I heard this company is going to be doing good. Or I'm buying the stock because I looked at the history of it, it has a good performance. Or this company has come up with a new product, and I looked into it, and the product seems to be a winning product. But guess what, folks? Those are all speculations. Even the past trend of any stock is not predicated on the what? Or is not the reason for future value of it. Anything that has a past performance, not necessarily is going to be repeated the same performance. Most likely it may, but nothing is as precise as you should invest on it. Therefore, then in that case, if these are all based on supply and demand, speculation, and all these good stuff, then what is the function of stock analyst? What are the function of all those companies that they value their stocks, value of what the stocks of other companies and stocks of the market, and why we have these hoopla that are millions of people in financial market every day going up and down. What's the reason? Well, the reason is that majority of the people that buy and sell stocks in our country, they do not know how to determine the true value of the stocks. They do. Who are they? Who are they? I'm going to tell you who these people are. People that are in the stock market and they are in trading the stocks, analyzing the stocks, and they are the companies, let's say CFOs or financial managers. They are different. Who are these people? Many of those stock market analysts, they are the people that are very smart and well educated, believe it or not. Many of them are like rocket scientists. Many of them are like physicians. Many of them are engineers, computer programmers. Many people that do have very, very high educational level. Then in that case, the question is, why in the world they are in the stock market? Because they love money, that's why. They want to go to the market and make money, and they know they are smart people. They could make it happen. That's number one. Number two, they have tools. We don't. What are those tools? All the methods that some of them we're going to learn in this class. Formulas, analytics, data, and information that we don't. They have it. They have, believe me, folks, there are like 4 different ways of determining the value of stocks, which some of them we're going to talk about in this class. That if you do it for all the stocks of the market, it's going to take a good portion of your week, let alone day. That's what they do. Not only that, all these, plus they dedicate every minute of their lives to do this, for every day. Which one of us are going to be matched with these people? None of us. So what's my point? My point is, forget about beating the market by just coming and telling my cousin told me so. Don't ever do that. Don't ever buy and sell any stocks just based on the speculation or rumors or somebody's recommendations. You know why? Because those people even cannot beat the market, let alone you and I. The only way that you're going to beat the market is beat one of those people and be on the floor of the stock market and aggressively take a chance. Yeah, you may beat the market. Other than that, no way. So, therefore, what is our function here? So what do we need to do? What we need to do is that we need to learn the fundamentals. What are those fundamentals? All the things that those stock analysts use as a tool. And they use myriads and multiple different approaches. But we're going to talk about some of them here in this classroom. So we've got to know how to do these. In order to do some of these, you need somewhat basic knowledge. Like what? Like mathematics, like statistics. Other than that, you can't do it. And most importantly, financial knowledge. To know what does it mean? Discounted dividend model. Oh, what do you mean by discounting? Do you know what discounting is? Well, the majority of people don't, but you do, because we talked about it. What is discounting?
Finding present value.
Finding the present value of your future cash flow. Do people think about it like all the time like that? No, they're not even aware of it. So, knowing all these. Knowing statistics, mathematics, and financial knowledge. Okay. So, that's kind of an introduction to tell you what stocks is all about and what is our function in learning the stocks and why we need to learn the stocks. Now also, this is something also I earlier shared this with Stefan about stocks. Somebody may ask you a question, okay, let's suppose that you have the tools, you have the ability to determine the true value of any stock. So what's the outcome of it? What's the benefit of it? Benefit of it is this. When you, through those methods, we're going to learn those, find out, let's suppose, the value of the stock, or the true value, which we call it intrinsic value of the stock, is $20. That's what you come up with, let's suppose. And then take a look at the market. How much market is trading this stock? Oh my God, they're trading this stock $40 in share. What's your action here? What are you going to do? You find out, you calculate it, the true value of this stock is $20. However, currently, market is trading the stock with $40. What are you going to do?
Sell.
Get rid of them, because each one of them is going to give you $20. That actually is not part of their value. Market basically gives you that. Grab it. So if you have 10,000 shares, sell them right away. Because each one is going to gain you, what, $20. On the other hand, if you come up with the intrinsic value of the stock, it says 20, and then you look at the market currently sells this stock for $10. What is this? Meaning that market doesn't know the true value of this stock. You know it. So buy as many as you can. This is how you buy and sell stocks. You don't buy and sell it based on the flip of a coin. Okay. So, let's take a look at some of the things that is in your book. The stocks are called what? In financial world, stocks, common stocks are referred to as
Equity.
equity. Thank you, Charles. And the meaning of equity is, not you. The meaning of equity is
Claim on asset?
exactly, thank you. So, what kind of asset that when you have the stock of any company, what is your claim of asset of that company? Meaning that you really, through your stocks, you have the claim of asset of that company. Meaning that if you have 10% of the total stocks of this company, 10% of asset, real asset of that company is yours. Follow? Okay, so equity. Bear in mind, whenever you see equity, you hear equity, that means common stock. Of course, I'm sure that you heard in stock, in the financial news when you watch TV, they use the term like private equity company, publicly traded company. When they say private equity company, what are those? Their stocks are not being what? Traded in the stock market. They are held by what? Private individuals, that they don't buy and sell those stocks. So, sequences of events that take place, which make an interpretation about this particular slide. Sequence of the events that take place is like this. If we're saying that the stockholders do have the claim on the asset of the company, right? Then in that case, we could safely assume that they are the owner of the company, right? But wait a second. If we all here do have the majority of the stocks of Qualcomm, let's suppose, right? We own Qualcomm, or a major portion of it. Well, wait a second. Qualcomm is run by the people that none of them is part of us, right? Hey, they have their CEO, CFO, VPs, managers, directors. I'm the owner, but they are running it. Are they going to be looking after my interests? What do you think? Think it realistically. We are, all of us here, majority shareholders of Qualcomm. We're the owners. But none of those people that were running this company, even we do know the names of it, let alone to know that they are who they are. Question is, how do we know they are looking after our interest? With owners. Maybe the CEO of the company or Qualcomm ambition is to make the company bigger to get more salary, more money. They don't care about losing your value of your stocks. Not that they don't, but what I'm saying is, what if? How do we guarantee that our money is not compromised by some people out there because of their own benefit, personal benefits? What do you think?
The board of directors?
Thank you. What we do as owners, as stockholders, we go find the people out there, outside of the company, and we ask them to represent us. Okay? What type of people? Well, people that they are in know, they have know-how, they have knowledge, and they are involved in this type of businesses, or people that also they are shareholders, majority shareholder. Oh, each one of us have a 1% of this company. Oh, Stephen has 10%. Stephen, would you like to represent us? Yeah, sure. Those are called members of board of directors. That's how the board is created. Who are these people? Normally they are like CEO of other companies, CFO of other companies, majority shareholders of this company, business owners. Sometimes you have colonels or generals, retired generals sitting there just because they have also few shares, but they have, some status in the society or so forth, so on. Those people we trust, we select as board of directors. How do we do that? Have you, any of you have stocks at all?
Yeah.
Do you get proxies?
I think that happened once, but...
Yeah, you should, every year. What is proxy? Hey, select our board of directors. That's you. You're selecting it. But of course, most of the time, what we do is, just because we don't know those people, we say, yeah, okay, whoever that was there, it's okay with me. That's how we respond to proxies. But actually, if you want any changes, mark it. I don't want this guy named Daniel Shoddy in the part of our board of directors. I want somebody else. Then you have the right to ask that. And of course, if majority votes that I shouldn't be there, they kick me out. They'll bring somebody else that you nominate. Follow? Okay. So, what's the point? Point is that there are a bunch of people in the organizations or companies or firms, I should say, that they are called agents, and there are a bunch of people in that particular firm that are called what? Principals. Is CEO agent or principal?
Both, right?
Yeah. How about CFO?
Agent?
Yeah. So everybody in the company is agent, including CEO. Owners or the principals are the only owners, only stockholders, basically. So, is there any discrepancy between the goals of principals and agents? Yeah, it could be. Could be that what you look for to see what happens to your investment if you have stocks of one company. The only thing that you care is what? The value of stock. Your stock goes up. That's it. You don't care if this company is going through a transformational process or they have put emphasis on the safety of employees. You don't care. Do whatever you need to do. The only thing I care is what? Increase in the value of my stocks. Because of exact this reason, remember what I shared with you on second week when we talked about ratios. I said the biggest and the most important ratio for any company or any firm is what?
ROE?
ROE, return on equity. Guess what? If the CEO of the company do not put the emphasis on it, does not make that as a priority, he or she is what? Short-lived. They're going to kick him out. Kick her out. Who's going to kick out? Board of directors, of course. Whereas the representatives are what? representatives of stockholders. So, who hires the CEO of the company?
Board of directors.
If that individual is not going to be performing based on the interest of the stockholders, is out. She's out. That's how it is. Now, that goes also answer a major question. A question that many people have, and I have seen those questions not only among my own community, but also in the media. I see that. There are many debates out there that they ask this question: why in the world the compensation in the salaries of CEOs has a Grand Canyon gap between them and the rest of the company, which is true. In a company, when you see that people in average, they make $120,000, even your CFO makes like about max $300,000, your CEO earns $5 million, meaning that there's a big, big gap in here. Why so? Why CEOs are rewarded so much ungodly, if you will? Now you could have the answer based on what we talked about. Why? Because first of all, those rewards are not in form of cash. They're in form of what? Stocks of the company. So when you give that many stocks to your CEO, he or she has no other choice than looking after your interest, which is also his or her interest. Am I making sense? That's the reason. For instance, I'm sure that you read or saw in the news, sometimes they say, yeah, this company's in trouble, but they bailed out this company, but the first thing that they did, they rewarded their CEO $6 million as bonus. And you say, what? No, that's the reason. They want to buy, basically, CEO's commitment. Any questions so far? Okay, intrinsic value of a stock is the true value of a stock, real value of a stock. The value of a stock that is not based on the what? Market speculation. It's not based on supply and demand. It's based on what? The true analytical approach to stock to come up with the true value of it, by formulas, by calculations. So, where does that come from? It comes from this. I think I showed you this before, didn't I? Yeah, so you already know about this, but just this is just because about the stock is in your chapter 9 again. So, you already know what this is. The intrinsic value comes from the true risk assessment, the true invested cash flow, and this one comes from what? The perceived risk and perceived cash flow, that we call it also speculation. Now, what are these two here that creates the stock's intrinsic value? Number one is your anticipation of what kind of cash flow this stock is going to be providing you. Remember, one of the things that I repeated a few times, when you make any investment, the first step that you take is what? Calculate the cash flow generation of that particular investment in the future. Because if you do not know what kind of cash flow that your investment is going to provide you while you're investing, you shouldn't be investing because you have no idea what you're investing in. Remember my example? Hey, I'm buying this building. Why are you buying this building? Because I calculated the rent and all these things that I'm going to get out of this building is going to supersede my investment in the next 20 years. Oh, okay. And well, how are you going to figure this out? Well, I'm going to discount those future values to present and compare it. Simple as that. Now here, you do the same thing. What is the cash flow generation of stock? What is it called? Dividend, right? And also capital gain. But dividend is the most important one at this moment for us. That's how you're going to determine the intrinsic value of your stock. Also, oh my God, I calculated this. My stock is whatever the value, and when you come up with the percentage of rate of return, it's 24%, has 24% rate of return. That's wonderful. Yeah, wonderful. But you're forgetting about this. Calculate the risk associated with that stock also. You're going to see also risk associated with that stock is 4 times as the average of the market. You want to buy it? Go ahead. You follow? Okay. Then we're going to come up with intrinsic value. When the market price of stocks is equal to intrinsic price of it, mean that equals to each other, then we say market is in equilibrium, meaning that market is operating 100% efficiently. What are the odds of this happening? Very, very little. Unless all the people that are buying and selling stocks, they are as expert as a stock analyst, which we know is not the case. Okay, so how many methods we have to calculate the intrinsic value? There are 4 methods. Number 1 is called discounted dividend model. By the name of it, you could kind of anticipate what this is, right? Dividend is the future cash flow of your stocks. When we say discounted dividend, that means what? We're going to discount the future dividend payout of this stock and then figure out what is the value of it. Corporate valuation model is the second method. We're going to put emphasis on these 2 more than the other ones, but most important is discounted dividend model. That's what we're going to be learning definitely in this class. But all the other ones are not as important. However, I'm going to talk about it. I'm going to show you what they are. But what I'm getting at is that some of them are very comprehensive, meaning that you cannot do exercise on it in the class or even at home because it's very, very elaborate, like last one, EVA. Also, corporate value evaluation model is not a simple one, but you're going to know what it is. What's the purpose here? All these are being used by stock analysts on a daily basis. But what we're going to learn is to know first of all what they are, and the discounted dividend model, we're going to do a lot of exercise in the class for it as well. So we're going to be basically learning how to do it. Corporate valuation model is common of the value of the company or the firm. And then you're saying, okay, well, this firm, I calculated, come up with $100 million as what? Present value of this firm. How do you do that? Again, I'm going to refer back to one thing that I repeated 100 times, is that when you put together the cash flow generation of this company, whatever they're selling, whatever they're making, they have a cash flow that's common based on their sales. You're going to discount all these for a number of the years that you have in mind, and then come up with what? The value of this company. The moment you come up with the value of this company, then you're going to say, okay, what this company, basically what is the source of the capital of this company? Meaning that all the assets are bought by what? Well, let's suppose that all the assets are bought 80% with stocks, 10% by preferred stocks, and 10% by bond. Let's suppose that. You're going to say, okay, I'm going to deduct the preferred stocks and the bonds from the value of the company. I'm going to convert the value of company only in terms of what? Stocks. The moment you do that, divide this value by the number of the stocks they have outstanding, you're going to have what? The price of this company, intrinsic value of the stocks. Follow? Okay. PE multiply approach or multiple approach is, okay, again, one of those moments that I'm going to ask you a question. What is PE?
Price per earnings?
Price earning. What is formula for it? What's the ratio? What's the formula?
Price per share over earnings per share.
Yeah, he
or
said
margin.
it. Price earning, price divided by earning per share. Okay? So what's the significance of this? Is that you could come up with the value of the company by PE of it and then determine the price of the stocks. But you're going to say, wait a second. If you determine the price of stock of this company, it says PE is the price divided by earning per share. We don't have the price. Yeah, you're right. But in that case, you don't have a PE. Take another company's PE that is similar to yours, multiply by your last year's net income, that gives you the value of the company. How precise is it? Well, it's not as precise as other methods, but it's good enough for you to do this. We're going to see that also in a few minutes. EVA approach. Oh my God, what is EVA? And again, I talked about it. What is EVA? What EVA stands for? Okay? Economic value added. So what is MVA?
Market value added?
Exactly. Market value added is simple. How do we determine that? First of all, what is it? And how we calculate that? Folks, it's very simple. Market value added, it tells you how much your company or your business had added in value in the market from the day that you opened the company. Simple as that. Everybody's with me? So basically what we're saying here is that your market value of your company compared to what? Book value of the company. Follow? Okay. Your stock also could be calculated in the same way. Why should you start with $10 a share? How much is selling currently? Oh, it's selling $20. Okay. So what is market value added? Twice as much. However, this is not as important as economic value added, because economic value added gives you something even better than that. What is that? Economic value added is spread between capital, cost of capital, and capital gain. Okay, what is cost of capital? How much the money that you invested for this company or whatever with this investment costing you? We're going to talk about that over the entire week. Cost of capital. And how much money you made out of this particular investment. Difference between these two. Make sense? Spread between cost of capital and capital gain. Now, is there any formula for it? Absolutely. The formula for this one, MVA, is very simple. The book value versus market value. But here, you take all the equity owners or stockholders value of your company and multiply by your debt ratio. Actually, it's not debt ratio, it's your equity divided by debt. We'll see that in, I'm going to show you how to calculate it. Basically, it's determining the difference between capital cost and capital gain. Now, what is EVA approach to determine the intrinsic value of the company? You're going to calculate the future EVA of this company and discount it back to present and come up with the value of the company and then value of the company in terms of common stock and divided by number of the stock. This is a very comprehensive model. You're not going to do none of these. This is very comprehensive. But you're going to know what it is. Who uses that? Like I said, stock and analysts use all these four models in combination. Okay. So is there any formula to determine the intrinsic value of a stock? Of course there is a formula. And that's your formula right there. P0 hat. Any letter that has a hat on it, it means what? Expected. Means that what is the expected value of this stock? Expected value of this stock is equal to D1 divided by 1 plus I power of n. Okay. What is D1? Well, actually, I'm going to rewrite this a different way, and then we're going to come up with D1.
What's your first year dividend?
R and I both are my interest rates, but each one has certain place that signifies something else. Okay, so D1 is basically your dividend on year one. And of course, if I put 1 in here, I'm going to put 1 also power of 1 because we want to calculate it for first year. For second year, it's going to be D2, dividend paid in that particular year, divided by 1 plus R multiplied by 2, as you can see here. And finally, for all these years, and your formula would be dividend of infinity divided by 1 plus RS in power of infinity. Now, why we have infinity here? Because stocks, as long as company exists, their stocks are going to be existing. You're not going to say that these stocks are going to be expired. It's not like bond. When you have 10 years bond, after 10 years, that bond doesn't exist no more. Okay. This is basically gives you an idea. This formula is not the formula that you're going to be using. Of course, you're going to be using, but gives you the idea that, hey, value of anything, which in this case the price of the stock, is equal to all the cash flow that the stock is going to be generating, however, discounted to present. You follow? 1 plus R power of 2. Those are discounting what? Factors. However, if you want to calculate the stock value for different particular years, you're going to go with this formula. What is the difference here? The difference is G. What is G? Growth rate of dividend. Folks, if you are calculating the value of your dividend in the future years, what if your dividend is grown every year?
Right.
If that's the case, then you have to include G, which is the growth rate. Yes, sir.
Oh, I was about to add, is this what's known as dividend aristocrats? I don't know if you've ever heard that term, but they've been increasing their dividend payouts for the last 25 years. Is that what this is
The
referring to?
payout is different.
Oh, payout, never mind.
Okay. I'm going to tell you what the difference between the payout and growth of the dividend. Growth of the dividend is growth of earning per share that is distributed to stockholders, not all of them, but whatever the proportion a company has in its mind to give dividend to their stockholders. Let me put it in this way. You're going to find this out, you're going to see that in the future discussions. Companies use certain models to pay dividend. Why? Because not all the earning per share is what? Dividend per share. Meaning that 100% of what you earn per share is, you're not going to pay all the time as your dividend per share. Why? Well, why not? Why are you not paying your stockholders your earning per share as dividend per share?
Because you want to retain something.
Yeah, you want to have some money remaining for you. Forbid it, you want to reinvest or do whatever you want. Because all the companies, all the time, are going to be requiring some money to grow. You're not going to borrow money every year to grow your company while you're paying all your net income as a dividend. That's silly. So is there a model for it? Yes, we're going to talk about that later. But for now, to just reiterate on what Josh said about the payment of dividend, is that you have to have earning per share and growth of earning per share in order to have what? Growth in your dividend. What portion of this earning per share is going to be dividend depends on the company. So, answering your question, Josh, is that yeah, it is, but it's based on your earning per share. Because sometimes you have the earning per share, but they decide not to give you dividend. Sometimes you get the dividend without having the earning per share. But when you look at it, you're going to see that your dividend of a company has a growth rate throughout the years. And is that applicable for all the companies? No. Certain companies do not have any growth rate for their dividend. Some companies have negative growth rate for their dividend. But most of the companies do have growth. So, we're going to use this formula. D0. Okay, now let me just start by saying this. When you have the growth, you're going to calculate the growth of your dividend by saying D0 multiplied by 1 plus G power of, let's say, 1 in this case. Do we have all the information here? Always? The answer is yes. What are these information? D0. What is D0? What you gave as a dividend last year. Is it always known? Yeah, it happened. Always it happens. So D0 is always known. What did you give as a dividend last year? The next one is G. What's the growth rate of your dividend? Well, you could calculate that yourself. You look at the history of it. Normally, the growth rate of dividend is published. But even if it's not published, take a look at the last 5 years of the dividend payout. And then do the simple moving average calculation. What is simple moving average? Add them all together, percentages, divide by number of years. Oh, for the last 5 years, what was the percentage of growth? This was the percent of growth. Add them all up, divide by 5, which is 5 years. That'll be average of dividend growth. So those are known. Week 2 dividend, I'm sorry, year 2 dividend is again dividend paid last year, this time what, power of 2, and so far, so on. So our portion of our stock valuation is always known. D0, pay dividend paid last year. 1 plus growth rate, whatever growth rate you come up with, 6%, 8%, whatever. And G down here is also known, it's the same. So what is the unknown here? The only unknown, RS. Okay? How are we going to determine RS? This formula. This is called, and I want you to remember this because I'm going to ask you this question in the future. This model is called CAPM for short, for capital asset pricing model. This also is referred to as security market line. Or SML. Now, what's the difference between SML and CAPM? Really, there is no difference. It's just a matter of the usage of it. When you use it to calculate this, you say this is capital asset pricing model. When you don't use it, you want to take a look at it, whatever it is in the market, it's already calculated, but you want to know what it is, called security market line. But they are the same. Now, what is this formula? Well, guess what, folks? This formula is being used 1 million times on a daily basis with all the stockholder analysts. And it's simple in a way. What the rate of your stock is equal to risk-free rate. Again, one of those moments that I'm going to ask you, what is risk-free rate? We talked about it.
T-bill rate?
Everybody here, Charles, comment? T-bill, treasury bill, or short-term treasury bond. You guys remember what is it equal to?
R star plus
That's your risk-free rate.
interest.
Okay? Is it always known? What do you think? Is the treasury bill rate is always known?
Yeah.
Of course. So it's always known. Plus market risk minus risk-free rate. what is market risk? Market risk is that historically, what is the rate of return of these stocks throughout the history? That's market risk. It's basically estimation of the average of rate of return of stock of this time, whatever this is. Let's say this is computer industry stocks. What's the total rate of return of computer industry stocks throughout the years? About 12.5%. Okay, use 12.5% here. So is it always known? Yep. Okay, finally, B. B stands for beta. What is beta? Beta is risk coefficient. What do I mean by risk coefficient is that there is a coefficient or a number or an index that signifies the risk associated with this stock. Can we calculate that? Yep. Are we going to be calculating this in the class? Yep. It's part of your chapter 8 that we're going to talk about it in future discussions. However, the question is, so my God, I cannot come up with the intrinsic value of my stock unless I sit down and calculate beta, and that's a little bit, needs a little bit of work, meaning that you have to have good knowledge of linear regression analysis to calculate that beta. But if that's the case, that all the companies sit down and do the linear regression analysis to come up with the beta, no. Betas normally have calculated by some major companies, let's say Qualcomm. And then if you're in the market for whatever the Qualcomm is making, let's say microchips, well, I don't know my beta. Take a look at Qualcomm, almost the same as yours. For instance, beta for all the computer companies is 1.2. Use that. Why is that? Does that mean that Apple is exactly 1.2 and Microsoft is exactly 1.2? No, Microsoft is, let's say, 1.21, Apple is 1.19. But average is 1.2, so don't worry about it. Follow? So what that signifies? If your beta is more than 1, it means that you're more riskier than the average of the market. If it's less than 1, your risk is less than the average of the market. If it's equal to 1, your risk associated with this stock is equal to the average of the market. Follow? So if your beta is 4, what does it mean?
You're very risky, extremely risky.
You are extremely risky. The risk associated with your stock is 4 times as much as average of the market. Basically, this stock is a bomb. It may go off any day. Okay? Now, like I said, I'm going to show you how to calculate beta as well. But in reality, many companies don't even bother calculating. They look at the beta of the industry that they belong to. And normally that is accurate enough for them to use it. So, we have all the information. We could come up with RS, and that's the last item, and we could determine the intrinsic value of stock. Any questions? Again, I said something that I was hoping somebody say, hey, explain to me what you said. I said, if your, this is risk coefficient, and if your beta is 1, the risk associated with your stock is equal to average of the market. And I was hoping that somebody said, Dan, what do you mean average of the market? Where we're going to get average of the market?
S&P 500?
Yes. All the things that you see on news when they say Dow Jones average industry is this and the S&P 500 is this, those are the benchmarks. Those are the standards. Those are the average of the market. So is your stock yielding more than that or yes, less than that? You follow? Since we're talking about the same subject, how do they come up with these indexes? We have three of them, three major ones. S&P 500, Dow Jones Industrial Average, and NASDAQ. How do we come up with those indexes of these three different entities?
For the Dow Jones, they pick each industry and then pick out like the biggest in each industry. Is the S&P 500?
Those are all the same method for different
Same
companies that belong to different type, meaning that NASDAQ has a bunch of its own company, S&P 500 has its own companies, and Dow Jones has its own companies. And why it's called S&P 500, meaning that they were only 500 companies when they started. So what they do is exactly what you're saying for all these. They go and pick the stocks of certain companies in each industry that best represent that industry. For instance, if we are the people that we're making these decisions, we go industry by industry. Okay, what would be a good example of a small package and service industry? Which company represents this best? Well, FedEx or UPS, right? Okay, let's pick up FedEx. And then you go to airlines industry. Let's talk about which of these airlines best represent the whole industry. Well, let's pick American Airlines. Follow? They go to all the different industries. Let's say go to computer industry. Well, maybe we pick up IBM, that's best representative of computer industry, and so forth, so on. So when they pick these companies, they put it in a basket. Imagine a basket, and they say an average of the total performance of all these. Index would be average of performance of all these. So if your stock is performing above that, it's performing better. Below that, it's not performing as well. However, bear in mind that the whole market itself goes up and down, right? So when you look at the watch the news, when the financial news comes around and they say Dow Jones average was, let's say, minus 0.94% with the red going down, it means that an average, the value of all the stocks in these indexes reduced. And you always see three of them. The S&P 500, Dow Jones Industrial Average, and NASDAQ. For each one, you're going to see that red flash going down. One point, let's say one off said 0.94 decline, the other one says 0.84 decline, the other one says, I don't know, 0.75 decline. Also, you could see what? The green, that all these markets go up. Very seldom you see one is up, the other one is down. And it's not impossible, it happens. You know, Dow Jones may be performing better than the other company, but normally it's not.
What's that?
Yes?
Yeah.
Well, this basically shows you the dividend growth, how you calculate that. Your dividend grows. If you want to know the future value of dividend, is that red one.
Okay.
And the blue one shows the what? Present value of the
Discount.
future. Yeah, and graphically, it's nothing really earth-shattering there. So, what if your growth rate is higher than your what? Rate of return on your stocks? Is it possible? It is possible, but it's very unlikely that your growth of your stock is more than rate of return. Why? Why this is almost impossible? Because your rate of return of your stock consists of two elements: dividend growth and what? Capital gain growth. So how can you say that your dividend growth is higher than your total rate of return? It cannot be. You follow? Because your R, which is total rate of return in your stocks, RS, is equal to dividend yield plus capital gain yield. You're saying this is less than this. It can't be. Only way it could be is that you don't have absolute capital gain yield, and this divorce is going to be equal to this, but not more than that. You follow? Okay. This is an example of how you use your capital asset pricing model or SML. They're the same, like I said. So it says if your risk-free rate is 7%, meaning that you looked at the T-bill rate currently is 7%. You look at the average of market risk associated with this type of stock, or in other words, rate of return of this type of stock historically is 12%. And this stock is located in computer industry, and beta for computer industry is 1.2. So what's the rate of return of this stock? Rate of return of this stock is 13%. Okay? Let's figure out the price of this stock. If our D0 is $2 and growth rate of our dividend is 6%, therefore our stocks is going to be yielding $2.12 on the first year, because it of course increasing the value by 6%. The following year is going to be what? 2.247 and 2.382 third year. We're using the formula that I showed you earlier, how the dividend grows. D0, right? And D1. D1 is divided by what? 1 plus RS power of 1, 2, 3, and so forth, so on. And we know that rate of return of the stock is, we calculate, is 13%. So to discount, that's how your dividend is going to be increasing in value by growth 6%. So far so good? But if you want to know what is the value of all your dividends in future payoff dividend, you discount all these with 13%. Because that's the rate of return of your stocks. It's not only the growth of the dividend. You follow? Growth of the dividend is only part of your total rate. So determining the price of your stock for the first year would be D1. How much was D1? 2.12. We already decided right there. Divided by RS, we already come up with the 13% for it. We calculated that. And the growth rate we know is 6%. Therefore, the price of your stock on the first year is going to be $30.29. Okay? Any questions? Okay. grab a pencil and paper, calculate this. Calculate the P0 hat, meaning the expected price of your stock. If the dividend payout last year was $4, the growth rate of your dividend is 5%. And the rate of return associated with this type of stock is unknown, but I'm going to give you other elements. Treasury bill currently is yielding 4%. Market risk associated with this type of stock is 12%. And beta is 1.2. Find out the price of the stock.
What was the risk rate?
Let me write it, actually it's easier, because I forgot it myself, just I'm making this up. Let me write it on the board. Okay, so, because I'm making this up, and later on, Dan, what was the say? Shoot,
Okay.
I said it, but I don't know. Okay, let's just write it on the board, that's much better. Okay. So we're saying dividend paid last year was, I said $4, right?
Mhm.
Yeah, doesn't matter. So we said that, what else? The growth rate was 5%. And growth rate of the dividend, obviously. So we don't know our RS. However, we know that risk-free rate was 4%. Market risk of this type of stock was 12%, and we know the beta is 1.2. What is the price of this stock? much are we?
48.84.
Anybody else? Or you working on it?
How much do you think on this?
48.84.
Just for this.
I got 13.6.
Yeah.
Mhm.
So, it's hard to see.
41.2, so that's 1.1.
Minus growth. Gives me -48. Yeah, the calculator also rounded it up if you don't have enough digits.
Yeah, that's what I got, 4651. Yeah. You can also think like if it's less than $4, you made a mistake because like, you know, if your I don't know, if your dividend's like way more than what you paid for the stock originally, then Gesundheit.
Okay. Everybody got it? Yeah? Any questions? Okay. Now, let's go back to this particular scenario here. Let's suppose that's the performance of our stock. Calculate dividend yield of this stock within 3 years. You know what I'm talking about, dividend yield? Meaning the total dividend this particular stock made the present value of those dividends? How much is it? Because this is the method that you learned, or you're going to use your calculator.
So we're just calculating 3 years of dividends?
Correct. What's the present value of future dividend of 3 years? Am I making sense? Anybody come up with the answer on that present value of the future dividend of the scenario? Okay. Using your financial calculator, I hope, right? And I'm going to do it with you again if you have any difficulty. Howdy? Yeah? Did you calculate it or no?
Yeah, I have.
You did it? How much is it?
What?
How much is that dividend? Present value of that dividend? Okay. I'm going to show it to you how to do it. Because this is the method that you learned a couple of weeks ago. Stephen, come up with anything? No? Okay, no problem. All right, Dan, this is very simple. Look, what I'm saying is that we have the scenario, and all you have is a dividend payout of this particular stocks for 3 years. Growth rate is 6%, and the discount rate is, what, 13% that you all calculated prior to this, right? So what are we going to be using this 6% for? only to determine the dividend payout for each year. That's it. Our dividend is growing at 6%, and we're going to get dividend of 2.12 next year, 2.247 following year, and 2.382 year 3. So far, so good. 6% is used to calculate only this. So what was our dividend paid last year? How much is it?
12 cents?
$2. This last year was $2. When $2 grows by 6%, becomes what? 2.12. That 2.12 grows by 6% becomes that, and that, so far so on. Okay? Now what I'm asking you to do, let's suppose somebody says, hey, you're going to get this dividend for the next 3 years. And that somebody's asking me, okay, what's the present value of all the dividend I'm going to get for the next 3 years? Good question. What's the present value of it? That's what we calculated. So how are we going to calculate? You're going to basically enter this is uneven cash flow, right? The method that we use, what your CF and you calculated. So we're going to go do it together, okay? All right. So first thing you want to do with calculator is reset your calculator. How are you going to reset that? Push second button, push plus and minus button, which says reset, and then enter. So your calculator should be saying what? RST equal to 0. Josh, you doing it?
Yeah. RST.
Stefan? Everybody's with me? Forwarding? Okay, good. Now, push CF button in your calculator. Your calculator should say CF0 equals to 0. Okay. What is our CF0 here? 0. Enter 0. Push enter button. So CF0 is going to show 0. Arrow down. What do you see in your calculator?
CO1.
CO1 equals to 0. What is our CO1? 2.12, right? Enter 2.12, push enter button. And then arrow down. You're going to see FO1, right? Arrow down one more time because we don't have F's in here. CO2, what is CO2? 2.247, enter that. Push enter button. Arrow down. FO2, we don't have it. Arrow down one more time. CO3 is how much? 2.382. Enter. Arrow down. Okay? So far so good?
What is the FO again?
Frequency of that number. Let's say you have like annuity. Let's say for 10 years you're going to get $252.
Right.
You're not going to enter it 10 times. Enter it once and then that F1 would be 10. Okay? Everybody's with me? You don't have your calculator with you. Oh, you have it? So you're there?
Yeah.
Okay. Next, since we don't have any F3 or frequency of 3, we're going to go and we're done basically. Push NPV button. Basically, you're trying to find out the net present value here is the present value is the same. So what do you see in your calculator? I need an answer. What do you see in your calculator?
I.
What?
I.
I equals to 0. Do you all see that? Yes? Please give me a feedback because I'm not seeing your calculator. So you're going to tell me what you see. Okay. What is I here?
3.
Huh?
3.
13%. We're discounting all our dividends with 13% because that's the rate of our stock. So enter 13. Push enter button. Arrow down. What do you see in your calculator? Please tell me.
NPV.
NPV. So you say this is calculator asking you, do you want me to calculate the NPV? You're going to say yes by pushing CPT button on the very top. CPT capture. What do you see?
5.2.
Present value of all our dividend paid in next 3 years is only $5.29. That's what it means. However, when you add these up, 2, 4, 6, almost $7. Is that what we're going to get? No, no, no. Present value of that is not $7, it's 5.29. Okay? Now, I want your attention because I'm going to tell you how even you can calculate the price of the stock by your financial calculator. For that, we have to do something first. When I try to come up with the price of this particular scenario, right? This doesn't give me anything except for dividend. And I calculated the present value of dividends, 5 point whatever, right? How am I going to calculate the price of it? Oh, I'm forgetting something. What is that? Here, my stock has a price, right? The stock is not zero, only it has the dividend. It has a price here. So what is that price that I could add to our what? Dividend of third year, and then do the same thing that we did a few seconds ago. Present discount them all with 13% to present. It's going to give you the price of the stock. Okay, how am I going to come up with the price of the stock at this particular moment? Well, you use this formula where I wrote it. I don't know, it's not P0 formula. Let me rewrite it for you. Okay. I'm going to say price of my stock right in here. How much is it? Okay, I know the dividend. So P0 on that particular column. The dividend for the third year is 2.382. Okay? What else I need to write in here? Let me see if you're with me.
Discount rate? Discount rate? RS?
Discount rate. RS, which is in this case how much?
Oh, 13%?
Yes. Minus what?
Your growth rate?
What is it?
6%.
0.06. Thank you. You're all with me. What's the price of this stock? Should be $30 something, right? If you come up with it, please let me know.
34.06.
How much?
34.36.
Excellent. $30.7, right? Or 07?
34.
34.
0.03.
34.
Oh, right here.
Okay, it's $34?
Yeah.
You come up with 34? Okay, that's fine. Okay, so we're saying $34 and how many cents?
3 cents.
3? 03?
3, yeah, 03.
03. Gotcha. Thank you. So everybody come up with that, right? Okay. So what I'm saying is this. Wait a second. Cash flow on my stock, dividend paid is 2.12 in first year, 2.247 second year. Third year, 2.382. But also, my stock worth $34.03 at that particular time, right? So what I'm going to do, I'm going to add 2.382 to the price of my stock. In other words, what is my cash flow on third year? Not only the dividend, but also the price of the stock. Follow? Okay, what is it? 36.5 41. That's cash flow I'm going to be receiving on third year. Follow? Okay, discount them on all back now with 13%. See what's the price of your stock right now? Now this is your, remember, this is your what? CF3 is not 2.38. 2.38 plus the price of your stock. So your cash flow on year 3 is 36.41. Calculate the, tell me what's the price of your stock. Any questions or you're clear? You know what I'm talking about?
Wait, so we were just measuring the cash flow? That's all we were doing? Like, so
No, what's the
discounting?
price of this stock? That's what we're trying to figure out. What I'm saying is that price of your stock is equal to what? Discount of your future cash flow with whatever discount rate you have, right?
Right.
Am I making sense?
Yeah.
What was your cash flow on first year? 2.12. Cash flow 2.24. 2.38 third year. Okay?
So why did you add the...
Listen, I'm not done, okay? Now, you got these cash flows. Your stock is zero here? No, it's not. What is it? Figure out the price of it at that point. And then discount them all back, and it gives you the price of today of that stock.
So the question that I'm wondering is, wait, why did you add the 238 on top?
Because-
Wasn't that taken into account by the P-hat formula?
What formula?
The P-naught hat? The discount, wasn't this taken into account in this formula?
Yeah, but see, you could come up with the price of this stock without doing all these calculations, the way that you did a few seconds ago, right?
Yeah.
But what I'm showing you here is that you could calculate the price of the stock on your financial calculator if you did that. Follow what I'm saying?
Yeah.
Is that you might be this stock for the next 30 years. Then you're gonna have trouble really adding these up and doing all this stuff. Your financial calculator could do that. But financial calculator says, hey, what is your cash flow on year 3? Well, this is only dividend, but stock also has a value. That's not what I'm going to get. But what is the value of that stock? Use the same formula, come up with the price of stock at this point, and then use your calculator. You follow? Meaning that if it's just for 30 years, then your financial calculator is going to give you the answer in 5 seconds. Versus if you don't use the calculator, you do with the formula, it's going to take long. That's what I'm getting at. Okay, so that's fine. But at least you got the point where how you come up with the, let's say, if you wanted to calculate the present value of your dividend of this stock, you know how to use calculator, right? Okay, good. Let's move on. Oh, shoot, you need a break. Let's take 15. Obviously, our D1 was 2.12, and our rate was, discount rate was 13% and growth rate of 6%. That's how we come up with $30.29, the price of the stock on year 1. Can you do it for year 2? Yeah, go ahead. One of the easiest way of doing is take 2.12, because that's the only thing that's going to be different for next year, right? Take 2.12, multiply this with 1.06. 1.06. You're going to have dividend of what? Second year. And the rest is the same. because your dividend from year 1 is going to grow with 1.06 to year 2. That's the only thing different. The rest is the same.
So, Professor, would a real shortcut just be taking 30.29 and multiplying that by 1.6, the beta, if you want to get the answer really quick?
You mean the price? No, the dividend, 2.12. Your dividend is going to grow with what? 6%, right?
Right.
How are we going to show that 6% growth on dividend?
Yeah.
Remember this. Right there. All you need to do is take and multiply with one more 1.g. 1.g here is 0.06, 1.06. So if you multiply 1.06 with your dividend, current dividend, it's going to give you what? The dividend of the following year. Let's go here, right there. So if you take 2.12 multiplied with 1.06, is going to give you dividend of year 2, which is, anybody come up with the answer? The next year's price, year 2 price?
32.10.
32.10, correct. Josh, here, 2.247 is byproduct of what? 2.12 times 1.06.
Nice.
But the moment you come up with this, the rest is the same. Okay, what I should do for year 3?
Multiply it again.
Yeah, multiply this, and then come up with the price of the stock for year 3. Come up with it? When you, what is it?
36.
Yeah, it should be right here. 2.382, right? Okay. So basically, that's what you do. Okay, now, let's go back here, and let's suppose that you did that. You say, oh my God, I came up with the intrinsic value of my stock. I know exactly how much it's worth. You look at the market value of it. All those things, you see this stuff is being traded $35. What are you going to do? Came up with the intrinsic value of the stocks is $30 and what? 29 cents. You look at the market and you see that this stock currently is trading for $35. What are you going to do if you want to make money?
Sell it?
Sell it. You're going to get almost $5 per stock. The true value of it is $20, but they're selling it for $25. So you're going to get $5 of profit for each stock. Now, of course, if you sell in one of them, it's not going to make much money, but if you sell in 10,000 of them, it's going to be, what, quite a bit of money. Okay, let's suppose you come up with this $30.29. And you're looking at the market and you say, oh my God, this stock has been traded for $25 in the market. What are you going to do?
Buy more of it?
Buy more of it. True value of it is over $30. Market is selling it for $25. Buy it. Any questions? Okay. One thing that I would like to invite your attention to is that the total rate of return of your stock, which is 13%, we already calculated, is not only from the dividend, it also comes from capital gain yield. So we say the total rate of return of our stock is equal to dividend yield plus capital gain yield. Dividend yield is that what dividend is going to be giving you. In terms of what? Percentage. And capital gain yield is how much the increase in the value of the stock or the increase in the price of the stock is going to give you. In terms of what? Percentage. So 13% should be equal to percentage of your dividend yield and percentage of what? Capital gain yield, okay? So how we calculate the dividend yield? You take the dividend of the first year or the year that you're calculating this, divide by the price of your stock. You're going to have what? 7%. That out of 13%, 7% of it is yielded by what? Dividend. Everybody's with me so far? So obviously the remaining would be by capital gain yield, which is what? 7 minus 13 is 6%. However, we could also calculate the capital gain without even, let's suppose we don't know. This is 13%. All we know is that our dividend yield is 7%. You want to calculate the dividend gain yield. Take the price of the current price of the stock minus the price of the stock, old price of the stock, divided by old price of the stock. So in this case, $30 was the old, 32 is current, divided by old, $30, gives you 6%. So 6% was your capital gain yield, 7% was your what? Dividend yield. Add them together, that'll be 13%. That's your rate of return. So, if somebody asked the question, hey, if I could come up with more precise rate of return on my stock if I calculate the dividend yield and capital gain yield and add them together, yeah, you could do that. But what's your purpose of determining the RS? To come up with the price of your stock. So, if you do not know the price, how are you going to be using dividend yield and capital gain yield? You follow? Okay. What if the growth rate is 0? Okay, we're going to go back. All the information is the same here. Let's go back here. Okay. So what I'm saying is that growth rate is 0. How are you going to come up with the price of the stock? So basically, for next 3 years, D1 is all D zeros. There's no growth. How are we going to calculate that? We're going to say what? D0 divided by RS, because there is no G. And D1 is what? D0 multiplied by 1 point G, right? So there is no 1 point G, and this is D0. And G is gone, D0 over RS. Another word would be what? Our D0 was what? $2, right? The rate was what? 13%. Divide 2 by 13%. That's the price of your stock. You see how big difference is? Your stock was $30 with the growth of 6% in your dividend. Your dividend is not grown, all of a sudden drop your price of the stock what? Half, 15. Okay, and this is the way it looks like. Hey, $2 was dividend paid last year. For the next 3 years, I'm going to have exact dividend to $2, and with the 13%. So basically, your dividend is also called payment. It's just a different way of saying it, but it's still your D0. Divide by R, that is 50.38. Okay? All right, here we go. I'm not expecting you to calculate that, but we did this. So, but I'm going to show you an example. The question is, now let's go back to reality. In reality, your growth rate of dividend is not going to be constant all the time. It could, but it's most likely in reality, the dividend growth rate is going to change every year perhaps, right? In that case, what are we going to do? How are we going to calculate? How are we going to calculate that? Let's say this is a good example. Let's suppose growth rate of your stock is 30% for next 3 years, which is very unusual, of course. Before achieving long-term growth of 6%, let's say after 3 years, your stock is going to be growing for 6% for foreseeable future. We don't know how long, but let's suppose 6%. So how are we going to calculate this? Any suggestion here? Not that I'm saying that you tell me exactly how you're going to calculate, but you're going to be telling me what I did earlier.
We'll be taking the average. Will we be taking the average?
You're going to calculate the price of your stock with 30% growth for 3 years. After that, you're going to find out your price of your stock at that moment, and then calculate it. Make sense? So I'm going to show you how it's done, that you see it. Here we go. So we're saying our growth rate is 30% for 3 years. Okay, so what are going to be our dividend? Dividend of $2 is going to be increasing with about 2.6 because it's growing with 30%. 30% growth of 2.6 is 3.38. 30% of 3.38 is 4.39. So far so good? All right, now we want to know the price of our stock after 3 years where the growth rate is changing to be only 6. Different growth. So what we're going to do, we're going to figure out the dividend paid on year 4. What is it? 4.394 with what? 6% growth this time. Everybody's with me? It's going to give you dividend 4.658. Oh, I want to find the price of my stock at that moment, and then from that point on, I'm assuming everything is what? With the growth of 6%. So you take, this is the dividend D4, divided by, again, the rate of your stock, with the growth rate that is going to be 6% from this point on. You follow? That's going to give us a price of the stock of 66.54. So you're going to go to your calculator, and you're going to discount your 3 of your dividends with 30% growth to present with 13%. And then you're going to discount this with 13% and bring it to present, add them all up. That's the price of your stock. Now, trick question. Can I calculate the price of my stock on year, let's say, 3, not the yield, dividend yield of fourth year, third year, or even second? That's fine, either of these years. Can I determine the price of my stock here or here? With the same formula, right? I'm a dividend divided by rate minus growth rate. In this case, it's 30%, right? Can I calculate that?
No.
Why not?
Because it would be a negative value on the bottom right.
Yeah, so what does it mean?
The money's taking money from you instead of giving you money?
No, it means this. You are calculating 30% growth of the stock with 13% discount. Where did you get this 30%? If your growth of your stock is 30%, your discount rate should be 50%, not 13. Follow? 13 is based on 6% growth. Or whatever we had in the past, that was 6%, I believe, yeah. That's why we come up with 13% with the capital assets price of model, remember? So if your stock is growing with 30%, my God, your rate of return on the stock is 50%. I don't know, 49%. It's not 13%. So if you enter 49 in there, then yeah, it could calculate the price. But you're right on point, exactly. It becomes negative and it doesn't make sense. Any questions or comments? Are we comfortable with all these stuff, folks? Yeah? I'm not hearing anything from anybody. Okay, now the reason I'm asking, do you need more exercise or shall we move on? I know you're all excited, but take your time, one at a time. So, Stefan, are you comfortable with this, or should we do some more examples?
More exercise would be good.
More examples? Okay. Josh?
Yeah, that's good.
More examples.
Okay, that's what I want to know. Because if I don't get a feedback from you where you're standing, I don't know whether I should move on or not. Now, in this example that we did, if you want to know what is your total rate of return, which is 13%, right? But you want to know what's your capital gain yield. Oh, and your also dividend yield. Your dividend yield is your dividend, which was what, 2.6 first year, divided by price of your stock, which we know now is 54. That gives you what? 4.81 as your dividend yield. Since the total rate of return of the stock is 13%, 13% minus 4.81 gives you what? Capital gain yield, which is 8.19. Why this is so high, 8.19 capital gain yield? Because your stock grew with 30% for 3 years. That's why. So again, but after 6 years, after third year, when your stock is going to be dropping for only 6% growth, it's going to be like, again, dividend yield 7% and growth, capital gain 6%. Okay. Why don't you do this and see if you come up with the $25 for your stock? We're saying this time, and it's not 30% growth on your stock is not growing for the next 3 years, it's 0. However, at the end of third year, your stock is going to be growing 6% for forever, let's suppose. What is the present value of your stock or the price of your stock? See if you could calculate this with your calculator. And that's it, you could, because what you're going to be doing, remember on the previous one, let me go back here first. You could use your calculator to calculate that. How? Again, cash flow mode, right? First year cash flow, 2.6. Second year cash flow, 3.38. Third year cash flow is 4.39 plus 66.54. Follow? because you're going to get this and plus the dividend. So you discount all these with 13%, you're going to come up with the price. This is how you're going to use the calculator if you want to use the calculator. Now here is the same thing. You could calculate it by just adding up and dividing and so far so on. But also if you want to use calculator, you're going to enter the cash flow of $2 first year, $2 second year, and 2 plus $30.29 as third year. With discounting of 13%, you're going to come with the price. But let's just calculate to see if you could come up with all these. Remember something, when you are doing the cash flow calculation, your CF0 in these scenarios are 0. So enter CF0, 0. And then arrow down CO1. Now here's the time that you could use F as what? 2 times or 3 times. But if you come up with 25.8, it's still okay. Because it's, we basically use decimal points, sometimes it's making a difference. But 25.7 or 8 is okay.
Professor, did you say the net present value should be 36.29?
Present value should be what?
Oh, the NPV should pop up as 36.29, or did I do something wrong?
No, actually, that should be, what is it? That's 30.29 plus what? Plus 2, 32 point, oh, I'm sorry, 32.41.
Okay, that should be the net present value.
That is your price of your stock plus your dividend at the end of 3 years.
Okay.
So you're going to enter this 0 for the first year, 2 for second year, 2 for third year, so 2 for second year. I'm sorry, let me start. 0 for 0 year, 2 for first year, 2 for second year. For third year, you're going to say 2 plus the price of the stock. But I'm sorry, not 2. 2.12 plus price of the stock, which is going to be 32.41. And that's your cash flow of number year 3. Discount back, what, 13%.
Oh, and then would that be the I value? Is this where you put in the 13%?
13%, correct. Everybody is okay? Yeah? Shall we move on? All right. Again, here, if you want to find out what was your capital gain yield, you know the dividend yield because it's a dividend of $2 and the price was 25.72. So your dividend yield is 7.78 if you divide your dividend by your price of the stock. Since the total rate of return was 13%, 13% minus 7.78, your capital gain yield was 5.22%, meaning that your stocks increased in the value with 5.22%. Okay, what if the growth rate of minus 6%? Would anyone buy this stock, and what is its value? Okay. So all of the figures that we have here, and where was it? The original one. Let's go back. Okay. Let's suppose this is our scenario. Let's go back to D1. And D0, of course, would be $30, but let's take this example. And it's about growth of 6%, we have minus 6%. Okay? What would be the price of the stock if there is any value on it, and is there anybody who wants to buy this stock? So how we calculate that? It's simple, right? So start with D0. D0 is $2, right? Multiplied by 1 minus 6. You follow? And then divide this with 0.13 plus 0.06. Follow? You could do that. You want to do it? Okay, if you, I'm going to show it to you anyways. This is what you're going to have. Okay? So I'm going to say that D0 is $2. Remember that? The part with D0 was $2. Multiplied by 1, it was 1 plus G. Now it's going to be 1 minus G. 1 minus 0.06 is how much? It's 0.94, right? Divided by 13% minus 6, which is going to be what? 0.19. So 1.88 divided by 1.19 is 9.89. This price of this stock is $9, 9.89. You see how big a difference it makes? It was like 32 something, now it's $9. Just because your growth rate is negative, it's not positive. If this stock has a still value, oh, of course it has value. It's $9.89, right? It's not 0, so it has a value. Any questions? Yes, Josh.
So the 1 plus G equals beta, right? Is that, or I'm sorry, is that, am I wrong on that? Or
Say one more time.
Beta is defined as 1 plus G, or can you not say that?
That's, you're talking about dividend, not beta.
Oh, okay. Yeah.
Dividend, yeah. That's your dividend, yeah.
I see.
Beta is totally different. Beta is totally different animal. You know why? Remember that on there, I put beta on the formula back there?
Yeah.
Okay, beta basically is your risk coefficient, like I said, meaning that you're going to see later on when we talk about it, is coefficient of variation of your stock, which we're going to calculate here. You're going to calculate how you come up with the coefficient of variation, which basically is your risk index. It could be 1, less than 1, and more than 1. If it's less than 1, your stock is less riskier than the average of the market. If it's more than 1, your stock is what? Has more risk than the average of the market. Equal to 1 is that your stock has equal risk as what? Average of the market. Any stock that has more than 2 beta is considered to be risky, meaning that the average risk of your stock is twice as much as average of the market. That's not good. But normally those stocks what? Yield you high rate of return. So yeah, beta is totally a different thing. Any questions? So here you have capital gain of -6 and dividend yield of 19%. So 19% makes up for that -6. Because -6 minus 19 is 13%. That was the rate of overstock. Okay, we're done with the first method. We have 4 methods. No, I'm not going to be going in depth on the other ones because, like I told you guys, the other ones are a little bit comprehensive. You have to spend a lot of time on some of them, but I'm going to tell you what it is. You know, you're going to have a firm understanding of it. But if you want to do some examples, choose to do it, it's going to be consume a lot of time. The second method that we use is called corporation or corporate valuation model. What this one is, folks, the way that I described earlier, is that instead of calculating the value of your stock or price of your stocks, you calculate the value of the entire company. Okay. If your company is based on, meaning that all the capital that you have, all the money that you have, and you bought your asset with this money, is all from what? Common stock, sales of common stock, and your job is done. Meaning what you're going to do? You're going to take all the value of the company in terms of common stock and divide by what? Number of the stock outstanding, right? That gives you a price per share. Everybody's with me on this? But in reality, companies are not financed by stocks only. They're financed by what? Stocks, bonds, right? And also preferred stocks. Because when we talk about equity, only is common stocks. No. Remember what I said about preferred stocks. Preferred stocks are not, normally are not traded in the trading blocks between people. Why? Because preferred stocks are given only to internal people. Executives receive those preferred stocks. Now, why companies do not issue also preferred stocks and say, hey, let's trade these two? Why not? What's that preventing the companies not to put the preferred stock in trading blocks?
They come with different privileges.
Like
rights.
what? Absolutely right. What is that privilege?
Do they usually, they get a dividend more often?
Not more often,
Bigger?
every year. Companies are obligated to pay dividend on preferred stocks. Again, obligation, when we say in finance, is not, it's a legal term, meaning that if the company doesn't give you, you're going to sue the hell out of them. No. It is that the company has to follow certain guidelines to ensure that preferred stock holders get dividend. Sometimes, when the companies do not make money, still they pay dividend on their preferred stock. How? They borrow money and pay the dividend. And that's what Charles referred to as what privilege is. Yeah, that's privilege. Meaning that if I'm the stockholder of IBM company and I have, I don't know, 20,000 shares of IBM, guess what? I'm set for life. Meaning that those preferred stocks are going to gain dividend every year, and it's going to pay me the dividend. So it's wonderful. It's a great thing to have. However, if you want to take a look at it, the nature of the preferred stocks are kind of hybrid between what? Between common stocks and bonds. Bonds pay you payment every year. They're obligated to give you what? The coupon rate. Remember all these? That's what we talked about it. So, what kind of stocks is like stocks, but in the meantime giving you the payment every year, which is in form of dividend, obligated to give you that. Well, gee, that's like bond. Yeah, it's hybrid between bond and stocks. That's why it's very much desired. Only is available for executives. When I was running the university, they gave me a little bit, not much, but I still have. Anyways, that's why we don't include preferred stocks in the in this particular model to come up with the price of our stocks. Why not? Because if we want to define or determine the value of our company in only term of common stocks, then we have to exclude what? Preferred stocks. Because our stockholders is not holding our preferred stocks. They're holding our common stocks. So here, the method is we're going to come up with the value of the company and then deduct our preferred stock and bonds from it, and we're going to come up with the value of our company in terms of common stock only. Then we're going to take that and divide it by the number of the outstanding stocks we have out there. It's going to give you a price of stock of that company. Now, should we take this method and do it all the time? Yes. We have to do all the four methods all the time because each one is going to yield you a little bit different in price. Let's say one is $13, the other one is going to be 13.1. Maybe one of them is 12.9. Very small differences, variation from each other. In that case, when you do all four of them, you're going to add these four together and divide by 4. Come up with what? Average of all these, which is more accurate than any single model. And that's exactly, in reality, what they do. Stock and analyst, that's their job every day. They do it for all the stocks. Now, how we're going to do this? In order for me to tell you how to do this, first you're going to be answering me a couple of questions. How do we determine value of a company? Is there any method?
ROE? ROE?
How are we going to do that? Is there any method to calculate the value of a company?
Figure out its expected cash flows,
Thank you. And then?
discount.
Thank you. And net present value, right? Jesus Christ, folks, I'm going to repeat this forever till you get sick and tired of it.
Terminal value.
Okay, so again, 4 steps. How we're going to figure out the cash flow of the company? Why I'm asking you? Did I talk about it? No. Then why I'm asking you? Because you learned this in your other course, accounting course. Right? So free cash flow of any company is equal to your EBIT, tax adjusted, add the depreciation and amortization to it, deduct it from your capital expenditure, add the change on net operating working capital. That's how you're going to come up with the cash flow of your company. All right. Do we know where to get our EBIT, right? Actually, I do have an example of this in chapter, I don't know, 14 or so. Couple of weeks from now, maybe, I'm going to give you examples on that, how to calculate. Because I have a scenario, I have a case study or the scenario that uses this to come up with the certain thing that I'm going to talk about. So you're going to see the real figures for this. But for now, let's see if we understand meaning of each one of them. What is FCF?
Free cash flow?
Free cash flow. What is the difference between free cash flow and cash flow?
It's like the availability, like how much free cash flow is, like how much available cash or cash equivalent. No, never mind.
I know you're making the meanings of it, but it's not that. Free cash flow is equal to net cash flow. What is net cash flow? Your cash flow that you're receiving minus what? Cash outflow of that particular period. Nobody in the world is going to get cash flow without having expenses, right? So your cash inflow minus your cash outflow is providing you what? Free cash flow. In reality, people use free cash flow, not just cash flow. In certain cases you do. For instance, in your stock, only expenses could be flotation costs, which is ignorable, but that's fine. Okay, that's your FCF. What is EBIT?
Earnings.
You know this.
Yeah, earnings before interest and taxes.
Thank you. Or it's called what?
Operating
profit. Thank you. Depreciation, we know what it is, right? But in order to reiterate the point, what type of depreciation do we have? Do we have what? Okay, let me rephrase it. How many methods do we have to calculate depreciation of our asset?
Is it 3 or 2?
2. One is called what? Straight depreciation. The other one is called what? Accelerated. What's the difference? Have you had this in your accounting?
Yeah.
Yeah?
Yeah.
Okay, so I'm expecting answers or comments. Okay, what's the straight one?
It's just linear. It's just straight. Did you say linear?
Yeah.
Yeah,
Let's just suppose that you depreciate $300,000, right?
Uh-huh.
For how long you want to do it? Well, for the next 10 years. So you deduct $30,000 every year.
If it has a residual life of 0 at the
exactly.
end, yeah.
So that's straight line. Basically, divide your depreciation, how much is going to be depreciated, in equal amount for a number of years till it becomes 0. Okay? What is accelerated depreciation?
There's like two. I think there's 2 ways of doing it. There's like some of the year's averages, and then there's I forgot, but I think there's like 2 different ways of doing it.
And why do we have to do that? Go ahead, Stefan.
Accelerated starts at a higher level and decreases over the time period being.
Okay.
So if you're going to do it for like 10 years, then you would begin, instead of doing it by 1/10 of the value, it would be 2/10 of the value, right? And then you do that like halfway.
Okay. Yes and no. Okay. Let me just explain to you why we have accelerated depreciation method, while we could easily take like equal amount of the money for a number of years and make it 0. Why even bother with accelerated? The reason we bother with that is IRS says, you know what? if you give me more money through your depreciation every year, I'm going to give you a break. Oh, okay, so how do you want me to depreciate this? Well, I'm going to give you the schedule. And that's why we have MRCS table, MARCS table. What is it? IRS provide that for you. Okay, how it goes. Specifically on the table says, first year, you're going to deduct 5%. Next year, you're going to deduct 15%. The following year, you're going to deduct 2%. The following year, 32%. The following year, only 6%. And there is no, for them, it has a rhyme and reason. But for me, when I look at it, why next year I have to be 7 and the following year 30%? Well, that's their figure. That's their method of providing you to benefit more from you. But you know what? In that case, you're going to say, why in the world am I going to do that, take care of IRS? IRS is going to tell you the reason you're going to take care of me is that I'm going to tax you less if you use this particular accelerated method than the other method. Therefore, guess what? All the companies use accelerated. They don't use this rate to take advantage of taxes. IRS gives you break. A certain percentage of discount if you use what? Accelerated table. So what you were saying, Charles, is that, yeah, every year is different. They're totally in. Now, how they figure out the different percentages for each year is their particular method. So, that's depreciation. What's amortization?
Intangible assets. Intangible assets. So depreciation is for real physical assets, and then amortization is for intangible assets.
Excellent, excellent. Capital expenditure, what is it?
Investment in long-term asset or like fixed assets.
Fixed asset, exactly. Buying a building, buying equipment, when you purchase fixed asset, that's called capital expenditure. Simple. Okay, what is net operating working capital?
So you add up all of the changes in the current assets and current liability accounts to find the net change in working capital.
Okay, so net operating working capital is your what? Total assets minus your total liabilities. Changes on it from one year to another. Make sense? Yeah, that's what we said. Okay, so you see this is actually simple. All comes from your financial statements, from your income statement and from your balance sheet. Take those out and enter it for all these years, you're going to have free cash flow for your company. Now, the moment you determine your free cash flow, what's the next step? We talked about it and we repeated it. Determine your cost of capital. Now, bear in mind, we're going to talk about this, bear in mind cost of capital that we're using here is not necessarily the hurdle rate that you say, I'm going to use it for everything in life. Not necessarily. You use cost of capital to discount your future cash flow when there is no mandated or expected discount rate. Let me explain what I'm talking about. Let's suppose that you're doing this calculation and you say, yeah, I'm going to use the cost of capital to discount all these for the present. Follow? I say, hey, I'm the CEO of this company. Don't use the cost of capital. Use our rate of return, meaning that if your cost of capital is 10%, what I'm doing with that capital in my company, I'm making 15% out of it. So use 15% here, not 10%, because I'm not going to expect anything less than 15%. When it's given to you, then it's just your discounted. When it's not available, nobody told you anything or nothing is known, then use your cost of capital. So here, what would be your cost of capital? Okay, I haven't talked about it. but I'm going to give you an idea what it is, and then we'll talk about it later. The cost of capital is going to be WACC, which stands for what? Weighted average cost of capital, which is going to be included the cost of your debt times the weight of your debt plus cost of your stocks times the weight of your stock. If providing that you don't have preferred stocks included, just common stocks and debt. Debt also should be adjusted to what? Tax in here. So that gives you a number, let's say 10%. 10% is the cost of capital that you're going to use as a discount rate to discount your free cash flows that you already projected for this company and know the present value.
Is that book value for the stock? Is that book value for stocks?
On this one,
Yeah.
no, this is market value. Market value of stocks. Meaning that here, let me put it this way.
Oh, is that like for a portfolio or for a company?
For a company, for everything, actually. If it, like I told you, if it's not dictated to you, if it's not expected or mandated, you're going to use cost of your capital. In other words, what I'm getting is that today, if you want to buy something, invest, buy this company. We're buying this company, you and I, okay? And we want to know what's our cost of capital to use as a discount rate. We're going to go to our CFO, Josh. Hey, CFO, look, where'd you get all this money from? Oh, we got 100 million, by the way. Where'd you get this money? Oh, I issued 60% stocks and 40% bond. Okay. So 60% is this, W is 60%. And bond is 40%. Okay. What our cost of debt? I mean, that was your coupon payment for these people. Oh, it's 10%. Okay. You're paying 10%. That's the cost of it. All right, what is expected rate of return on our stocks? Was 12%, meaning that our stockholders expecting to receive 12% rate of return on our stocks. Okay. 12% times 6%, 10% times 40%, add them all together. That's your WACC. So, your question, what is this weight? Weight is percentage, and stocks basically is expected or cost of equity or expected rate of return in the stocks. For debt is your coupon rate if it's bond, and it's what? If it's borrowed from bank would be what? In a stock, we shoot a stock, we borrowed from bank. In that case, the rate would be what? Interest rate, folks, come on. Follow? Okay. Did I answer your question?
Yeah.
Okay. Which we're going to talk about this later. You're going to have an earful of it in one of the future discussions. But for now, I'm just going step by step what we have talked about investment criteria. Here it is. You want to know what's the value of this company? Well, the first thing, calculate the cash flow of this company. For how long? For as long as you think the company is going to be existing. Okay. What's the formula for it? Right there. Where I get all this data? Where? From your financial statement. Income statement and balance sheet. Okay. So it's easy to do it. Yes, it is. Well, what I'm going to use for discount rate, what's the cost of your capital? How many stocks you had? How much stocks you issued? And what is the cost of your stock? How much debt do you have? And so forth. So on. Let's suppose, this should give you some idea, you didn't do none of them. You just went to bank and borrowed 100 million, which is very unlikely. But let's suppose you did that. What would be your cost of capital? What would be your cost of capital? I'm asking this question.
100 million.
10 million?
Whatever bank is going to ask you to pay as interest rate, that's cost of the capital. Hey, we're going to give you this money, but it's 8% interest rate. Okay, that's your cost of capital. Everybody's with me? Okay. So, I got my discount rate, I got my cash flow, I'm going to discount everything with my cost of capital, whatever that is, to present. And that's going to be present value of my company. Okay? Now, then I'm going to do something else. I'm going to say how much of my total capital, my total asset, or the value of all this company is by stocks. I'm going to go here. Oh yeah, 40% is by debt. I'm going to deduct this from the value of my company. And you're going to see an example of how we do it in just a second. Also, do I have any preferred stock that I have to deduct it from? If you do, then you do that also. But in this case, let's say you don't have it. So the value of a company would be only in terms of what? Common stocks. Then you're going to ask yourself, how many stocks do we have outstanding out there? Oh, we have 10 million. What was the value of our company? It was 100 million. So price of each stock is $10? Yep. Simple? Yeah. But I'm not going to give you any problems on this one for your midterm, because you know why? Because it's going to take time to do this. And we don't have 5 hours. But I'm not going to give you one. But I want you to understand it. I think there are some problems in the book that may have one or two of these examples. Maybe you want to tend to do a couple of them to be comfortable with it. But it's going to take time. That's what I'm getting at. You need to spend some time to come up with the cash flow of the company. Any questions or comments? Okay, this is one example. Okay, this is for the company, remember? We're going to say, let's suppose we have this particular scenario. You use that free cash flow model and you come up with the cash flow generation of this particular company. And you say, wait a second, this company is going to lose $5 million first year. However, it's going to make $10 million the following year, $20 million after that. And after that, the growth of this company, or cash flow growth of this company, is going to be constant 6% growth for whatever the period. Again, you're going to use the same model. These are all your cash flows. However, at the end of 3 years, your company is not going to die. It's not going to go away. It's still going to have value for forever, perhaps. Then how do you determine the cash flow generation of your company, or the value, what you call horizon value? Horizon value of your company, you do the same method that we did in our calculation of stocks. Take the cash flow of the 4th year, and then say, okay, cash flow divided by the rate. What is our rate? Let's suppose our cost of capital is 10%. Let's say we calculated that, it came up to 10%. 10% minus how much I'm going to be, or cash flow is going to be growing for the future. Oh, 6%. 6% horizon value is 530 million. Then you're going to discount all these back to present. How are you going to do that? Again, with the cash flow calculation of your calculator, you're going to enter -5 for first year, minus the first CF0 is going to be 0, CF1 is going to be -5, CF2 10, CF3 is going to be 530 plus 20, 550, if you will. Boom, discount them all back, it's going to be 460.94. The worth of your company is 460,000,000.942. Okay? Now, how much of this particular value is debt and preferred stocks? This company has 40 million in debt and preferred stock. So we're going to deduct the 40 million from where? 460.94 million, which is the worth of the company. So 376.94 million is the worth of this company only in terms of what? Common stock. Meaning that the worth of the common stock of this company is 376.94. What's our aim here? What's the goal? We want to find out the price of stocks of this company. This is the worth of the company in terms of stocks. How many stocks we got out there? 10 million. 376.94 divided by 10 million is what? $37 and what? 69 cents. That is the price of our stock for through this model, through this calculation. What was in our discount? Well, we'll see it maybe a little bit later. All right. You got the idea, folks? It's very simple in a way, but if you want to calculate it, it's time consuming. As you can see, you got to come up with the FCF for all these years with that method that we know. Okay. Also, we have two other models that we calculate, but these are simple. One of them is actually nobody uses, but it's there. PE model is, remember that PE was what? Price earning ratio. We talked about it earlier. You take the PE, okay, this is EVA model, I'm sorry. PE I'm going to talk about, okay. Take the PE of a similar company that is in competition with you in your industry. Normally the PEs in a comparable company, they are almost the same, so it's not a big difference. Take the PE of a company that is very close to you. Multiply the PE from your net income of last year, that you know what it is, obviously. So if the PE ratio is 32, and then you look back and say, oh my God, my net income was 10 million last year. So what's the value of your company? $320 million. Okay? So what? So you did the same thing. Deduct all your debts and preferred stock from it. Make it in more form of what? Common stock, the value of the company common stock, and then what? Divide by number of the stocks you have out there. Gives you the price. It's simple, isn't it? EVA model is most complex than all of them. And of course, I'm not going to ask you to do none of these, but I'm going to give you the idea of what this is. What was the EVA? How we calculate EVA? Right? Economic value added. We take, remember what I said. What's the meaning of it? The comparison or spread between capital cost and capital gain. What is your capital gain? Is return on equity, right? And what's your cost of capital? Cost of equity. What is cost of equity? See, I asked you to ask me if I use certain terms that you're not comfortable with. Ask me. Cost of equity, what is it?
Is that would that be dividends? Dividends? That'd be the growth rate for the...
Can I borrow this?
Yeah, absolutely.
This is the stock of my company, folks, right? I'm the issuer, and you're the holder, right? What are you expecting to get out of this? Rate of return, right? What is this to me when I pay you a rate of return is what? It's cost for me. So cost of equity is to me as a stock issuer, the rate of return that I'm giving you. That's the cost of equity to me. Follow? You're receiving this money. Who's paying? I'm paying. Well, how I'm paying? When I announce that expected rate of return on my stock is 12%, I'm obligated to give you 12% rate of return on it. That's cost of equity to me. To you, it's rate of return. But it's the same thing, two sides of a coin. Same coin. Thank you. So, cost of equity versus return on equity. Now, when we do that, we come up with the EVAs. Market value equity is what? The book value of all your equity, all your stocks, book value of it. And you take that book value of your equity, meaning that the day that you issued all your common stock, what was the total value of it? Take that, add it to present value of all your future EVAs. That's where it becomes complex. Because for each year, you have to do this calculation to come up with the EVA of each year. The moment you did that, you're going to discount it for the present and find out the present value of your EVA, add it to book value of your equity, and that's going to be your value, meaning that market value of that, this, if you divide by number of the stock the way that we did it in the past, it's going to give you the stocks. This is a little bit comprehensive. Now, do they do all these? Yep. Every day. Bear in mind, folks, life is not that difficult. You know why? Because most of these are computer software. All you need to do is just plug in the numbers, give you everything. You follow? All these are computer software these days. And all you need to do is, hey, you know, we want to come up with the value of this company. Okay, just enter the data in there. And it calculates everything for you, boom, right there. Now, then why we bother even going to all this distance? You are learning the concept behind it, why we do that. Yeah, it's like you take a computer class and somebody says, well, what am I doing here? All I know is just know after this button which one I should push to get my answer. Yeah, that's usage of it, which is simple. But you take the computer class to understand why it is that way, how it works in that way. What is the reason behind it? What's the logic behind it? How you manage all this? How you understand all this? So that's what we're talking about here. Are we going to be stockbrokers or analysts sit down and then do this every day? No. They understand what it is. They enter the data, computer spits out whatever they need to have. That's why I don't require you to sit down and calculate all this. That doesn't make sense. I talked about preferred stocks. They're hybrid securities. What is the meaning of securities?
There's an asset backing it?
Financial assets. Financial assets are also called securities. When I say securitize them, what do I mean? Hey, I'm securitizing all my houses. What does that mean?
You're trading a financial asset for a physical asset?
Yeah. And what do I do, for example? Okay, I said, you're absolutely right. Now I'm doing it. And what would the example of it?
Oh, like mortgage-backed securities? Or
Exactly. What is that?
that's where you took like the house.
I know, but what is it called? Bond. I issue bond. And somebody says, hey, what is this bond, bonds are backed with? Oh, my houses. I securitized my real asset, made a bond, made it financial asset. That's what the banks do. Mortgage-backed securities that you referred to is one of MBSs. Okay, finally, how do we come up with the value of our preferred stocks in case we have preferred stocks? Value of your preferred stocks is always very simple. Your dividend paid on preferred stock divided by rate of it gives you the value of it. Here, the value of it is given to us, meaning up there it says that, hey, preferred stock with the annual dividend of $5 sells for $50. What is the preferred stock's expected rate? Well, it gives you the different information. No, this is unknown here. Doesn't matter. Oh, $50 is the value of it. Dividend $5. What's the rate? This preferred stock pays 10%. Or if the problem was presented to you that, hey, my stock gave the dividend of $5 and the expected rate on it was 10%. What's the price of this stock? $50. $5 times 0.10. That's 50. I'm done. How about you guys? Any questions? Did we get some ideas about stock and stock valuation? There are 4 methods. And again, I expect for you to know at least 3 of them. The 4th one is comprehensive. At this time, we don't have the capacity for it, or this class doesn't have the capacity. But this is something that I want you to have for the rest of your life. Meaning that you are going to be, I promise you, you're going to be in a situation when you're going to be owner of stocks, whether you like it or not. That at least you have an idea how to evaluate your stocks. Make better decisions. Nothing else? Have a wonderful night. I'll see you guys next week. Oh, next week, bear in mind, you're going to have our midterm, right?
Yeah.
Okay.
Oh, do we need like a Scantron or anything? Oh, like, do we need to like bring anything with us, like a number 2 pencil or?
No, only the calculator.
Oh, just the calculator.
Only
Is.
calculator.
Oh,
But
okay.
the rest is piece of
I
paper.
have 5 classes.
Oh, okay. We don't need to like buy a
If you
paper,
need, you can
like
just
a
take the picture.
booklet, nothing like that. Okay.
Check with